In this video you will learn how exactly and in what situations emotions can influence our financial decisions. We will review and analyze the 3 most important emotions that affect finances. We will review the psychological traps that can prevent you from making well-considered financial decisions. And finally, we will give examples of situations where emotions can lead to mistakes in investing and money management and how to correct them. Sit back, give us a like, subscribe to the channel, and here we go. Chapter 1: Emotions and Finance. As you've already realized, money and finances are not just cold numbers on a screen, but are strongly linked to our emotions, inner beliefs, and psychological reactions. Here's how it works. 1. Fear and panic. When markets fluctuate or there is economic instability, fear can lead to a sell-everything reaction. People experiencing fear may make spontaneous decisions to sell assets, which can lead to losses. 2. Greed and risky investing. The desire to make more money can incline people to make risky investments. People who experience greed may invest in unconventional or complex financial products without considering their risk. 3. Confidence and underestimating risks. Sometimes overconfidence in one's own abilities can lead to underestimating risks. People may think they are invincible in the market and fail to take the necessary precautions. To successfully manage finances, it is important to develop financial literacy and learn to recognize the influence of emotions on your decisions. This may include creating a budget, an investment plan, and a risk management strategy. In addition, it is important to learn how to make considered decisions based on facts and goals rather than emotional reactions. Chapter 2: Emotions that play a key role in financial decisions. 1. Fear. Fear can cause us to avoid risk and keep funds safe, which is helpful in some cases. However, too much fear can lead to excessive conservatism, causing us to miss opportunities for capital growth. 2. Greed. Greed, or the desire to earn more, can encourage risky investments and trading without considering the risks. People under the influence of greed may ignore long-term strategies for short-term gains. 3. Confidence. High confidence in one's financial decisions can be a positive trait, but if it degenerates into arrogance and ignoring cautions, it can lead to big losses. Recognizing these emotions and their impact on financial decisions is an important part of financial literacy. Recognizing emotions and making decisions based on facts and goals, rather than emotional reactions, will help you manage your finances more successfully. Chapter 3: Psychological traps. Psychological traps can greatly influence our financial decisions and sometimes prevent us from making considered and rational moves. Here are some of these traps. 1. Confirmation bias. This trap is that we seek and accept only information that confirms our existing beliefs, ignoring everything else. For example, if we have already invested in a particular stock, we will only look for positive news about it and ignore negative signals. 2. Illusion of control. People often believe that they can control investment outcomes or risks better than they actually can. This can lead to an overestimation of their abilities and, as a result, risky investment decisions. 3. Utopian thinking effect. Utopia effect. This trap involves the tendency to overestimate the probability of positive events and underestimate the probability of negative events. People may view investments as an easy way to get rich while ignoring the risks. Being aware of these psychological traps will help you to be more vigilant and deliberate in your financial decisions. It is important to recognize how these pitfalls can influence your decisions, and try to make decisions based on analysis and facts rather than on emotions and fleeting impressions. Chapter 4: Analyze situations where emotions can lead to mistakes in investing and money management. Indeed, emotions can lead to all sorts of mistakes in investing and money management. Here are some examples of situations. 1. Panic selling. When markets begin to decline, fear and panic can cause investors to sell their assets at low levels. The mistake is that investors sell assets without considering their fundamental value and realize losses. 2. Impulsive investing. Sometimes the desire to make a quick buck can lead to impulsive investments in assets that the investor knows little about. This can lead to losses as decisions are made without proper research. 3. Overestimating risk. Confidence in one's abilities can lead to underestimation of risk. An investor may believe that he or she can successfully manage high-risk investments, which can lead to losses. Removing emotion from financial decisions and prioritizing sound analysis and planning can help avoid these common money management and investing mistakes. To summarize, remember, financial literacy and understanding the impact of emotions on financial decisions are important tools for financial success. Develop this skill and it will help you make more informed and educated financial decisions in the future. Thank you for watching our video, and don't forget to subscribe to our channel for more useful information about finances and money management. See you in the next video.